Before we dive in, just a quick disclaimer, I am not a financial advisor. This video is for informational and entertainment purposes only and is not financial advice. Always do your own research and never invest in anything based solely on what you see on the internet. Now let's get into it. So guys, for a while now, I've been feeling like the stock market's gotten a little bit too frothy, and it's starting to look like I'm not the only one who thinks so. Over the past month, the Fear and Greed Index has swung hard into the fear side, which tells us investors across the board are getting pretty pessimistic about where things might be headed next. And ironically, I think one of the biggest reasons for that fear is the same thing that's been driving the market to new highs for these last couple of years, and that's AI. It's no secret that most of the S&P 500's performance these past few years have been powered by the Magnificent Seven. Stocks like Nvidia, Microsoft, Apple, Amazon, and Alphabet, plus others like AMD, ASML, Broadcom, TSM, and even Intel, who are not in the Mag 7 but are all riding the same tech and AI wave in one way or another. And while that has led to some unbelievable returns, in some cases upwards of 90% just this year, it's that very same story that now has investors wondering, are we in an AI bubble that's about to burst? Even here in our own little corner of the internet in the comment section of my videos, it seems like a lot of you guys are starting to feel the same way, that the stock market feels a bit too top heavy right now. I actually got this comment recently from my friend Joseph, who said, "We've had a good long bull run as of late. I'm holding some cash in reserve instead of reinvesting right away to go on a buying spree if there is a correction. Guessing this quarter or Q1. In the comment, he also asked, what would be your ideal dividend recession picks if that happens? I keep a watch list just for recession picks. Now, first and foremost, I do want to say that I have no idea whatsoever what is going to happen next. I have no clue what the market is going to do. And even though it feels like we could be due for a little pullback, that doesn't really mean anything at all. That could just be gas, and that's actually usually a safe assumption. But like Joseph said, it is always good to be prepared. You want to have a plan of attack for if and when these pullbacks in the market do occur, because you don't want to waste a great buying opportunity just trying to figure out what you're going to buy. It can be pretty paralyzing when there are so many great deals out there. And I do have some thoughts, a little wish list of sorts, of stocks that I will be loading up on if and when we do see a serious pullback. These stocks are going to be my top priorities, and there will be plenty of other great buying opportunities out there, but these are the ones I'm most excited to swoop up if we get the chance. And I'd love to hear from you guys too. Which stocks would you want to buy if the market takes a serious hit? Let me know in the comments below. So guys, this first stock is going to be no surprise. I'm sure if you're familiar with the channel, you knew that I would be bringing up Rollins, or as I like to call it, my great white whale. I've been chasing this stock for these last few years. I first started talking about Rollins sometime in here, back when the share price was right around $32, $33 per share. So I've been really wanting to buy this one for over 3 years now. And in that time, the share price has done nothing but go up. In fact, it's practically doubled since I first started talking about it. And as we can see over the last 5 years, the share price is up almost 55%. Even looking at the performance just this year, about half of those gains over the last 5-year period came just here in 2025, where it's up 26.4%. And it started out the year at about $45 per share, which is still quite a bit above where I initially wanted to buy the stock. But as the years have gone on, now I've kind of changed my tune. And if we saw it pull back to around 45, I would definitely start a position in Rollins. But all this stock seems to want to do is go up. As we can see, it just keeps going up and up and up. And now it's approaching $60 per share. And so I feel like I have to wait for some sort of serious pullback in the market as a whole for Rollins to come into buying territory. But the thing is, I can't even blame Rollins. I can't even be mad seeing the share price just continue to go up and up and up, because the company just continues to put up great numbers. So it's really no surprise that the share price is going to be a reflection of that. Now, with that said, there's a good chance you might not have heard of Rollins before, because it is a bit under the radar and it's about as far as you can get from being a flashy AI-focused tech stock. But Rollins is one of the world's largest pest control companies. And what I like about this business is that the need for pest control is constant. It doesn't change with technology or economic cycles. No matter what happens in the world, no matter how fast technology evolves, and no matter what other changes may come, critters like ants, spiders, termites, and cockroaches are all going to be pretty impervious to disruption. They're always going to be around. You know, bugs are a tough thing to permanently get rid of, which gives Rollins a steady, reliable demand for its services, and that makes it a lot more resilient to economic downturns or, like I said, whatever else is going on in the world. And we can see that resilience show up in the financials. I mean, like I said earlier, the company just continues to put up good numbers from top to bottom. The growth is just constant. These charts are just going up into the right at pretty aggressive rates as well. Over the last 10 years, sales have grown by about 10% on average per year, earnings per share even faster at 13.4%, and free cash flow per share actually at the fastest, coming in at about 16% per year on average. And with that, scrolling down, looking at the debt situation, even though there is a bit of debt here on the balance sheet, and it does look like there was a big jump between 2022 and 2023, likely due to at least one acquisition, the debt is still pretty small in relation to the amount of free cash flow this company is generating per year. We can see the net debt to free cash flow in the trailing 12 months is only about 1.1, which means that if they dedicated all of their free cash flow in this time period to paying off the net debt, it would only take about a year to do so. And with an interest coverage ratio of about 24 in the trailing 12 months, their operating income can comfortably cover those interest payments. So debt really isn't an issue whatsoever. And then scrolling down, getting into the good stuff, looking at the dividend stats right here. Rollins isn't going to be the highest yielding stock, especially considering the share price just continues to go up. Right now, you can lock in a yield just above 1% based on the trailing 12-month payments. But still, unsurprisingly, based on what we saw in the growth charts, the dividend growth has been pretty phenomenal over both the 5 and 10-year period. We're getting mid-double-digit growth right here. And the dividend is also very well covered. If we look at the payout ratios in the trailing 12 months, they're getting about a 63% payout ratio, not too bad, and the free cash flow payout ratio is actually a bit lower, just below 50%. And then another thing worth noting about this company is that their returns on invested capital are incredibly high, and they're actually getting higher over time. Going back to 2020, which obviously was a rough year, they still generated a return on invested capital over 17%. And since then, it's done nothing but go up. And in the most recent year, it was over 21%. With all of that said, I do think my patience with Rollins will eventually be rewarded. In my mind, having this stock in my portfolio is inevitable. I just have to wait for the right time. And I do believe that some sort of widespread panic in the market, whatever that ends up looking like, will allow me to buy shares of this stock at a much more attractive price and also a much higher yield so I can stack up that passive dividend income even faster. And on that note, if you want to add another passive income stream to your repertoire outside of just dividend stocks, then you'll want to check out Limits Express Company, who's actually the sponsor of today's video, and I want to tell you a little bit more about them. So earlier this year, I started selling products on Walmart through Walmart WFS. In a nutshell, that's Walmart's own service that lets you set up a storefront on their website, send inventory into their warehouses, and then they handle everything once a customer places an order. They store the products, package them, ship them, the whole 9 yards. Now, the big question around all of this is, okay, well, how do you even know which products to sell, and where do you even get these products? I mean, how does all of this work? And that's the cool thing about how I've been running this. I've been working with Limits Express Company, who's managing the entire thing for me. Thanks to them, I don't have to lift a finger to run this store. It's completely passive and hands-off, and from the time I made my first sale in April until now, these are my results. As you can see, the returns aren't too shabby, and the only thing I had to do was put up the money for the inventory. Other than that, Limits Express takes care of everything else, from sourcing the products through their supplier network to shipping them to their own warehouse where they repackage that with your store's information and then sending that inventory into Walmart, where Walmart then handles the fulfillment. Now, the cool thing about working with a company like Limits Express is that they're working with multiple clients and they're placing these really large orders in bulk, which means they're able to negotiate top-tier pricing on all of this inventory, which means better margins when you sell it on Walmart and ultimately a higher return on your invested capital. And just like how I document my dividend investing journey here on YouTube, they're documenting their Walmart business over on their channel. They share educational content about Walmart WFS and post regular updates showing how their clients are doing, which I think is really cool to see, and I'll include a link to their YouTube channel in the description and also in the pinned comment. So like I said, they're very transparent and their incentives are aligned with yours. They only make money when you make money, so they are just as motivated as you are to get good results. And so far, as you saw a moment ago, I've had great results working with them. With all of that said, if you're interested in learning more about generating passive income through Walmart WFS, just click the link in the description of the video or in the pinned comment, or just scan this QR code right here to set up a free 30-minute Zoom call with Kyle, who's one of the co-founders of Limits Express. If any of this sounds interesting to you, I genuinely think the best way to go about it is just to outsource it to the pros who live and breathe this stuff every day. So definitely set up a call and start building another passive income stream with Limits Express Company. Now getting back to it, guys, unlike Rollins, I already do own Visa, and it's actually the largest individual stock position in my portfolio. With that said, if we take a look at my position over here using my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. Here we can see I have almost 24 shares at an average cost of around $270 per share. So with the current share price right at about $336, there's still quite a spread between the current share price and my average cost, and that's going to leave me up about 25% on my Visa position. And I do think if we went through a correction, or even if we went through some sort of recession, we could see Visa's share price pull back quite a bit. Since Visa is the world's largest payment network, processing trillions of dollars in payments every single year, and since the company makes money every time a transaction runs through its network, a slowdown in consumer and business spending would naturally hit their revenue. Fewer transactions with potentially smaller amounts on those transactions could negatively impact their revenue in the short term and lead to a pullback in the share price. But here's the thing, that kind of dip wouldn't, at least in my mind, change the long-term investment thesis on this company at all. Digital payments are only going to continue increasing as time goes on, and so when you zoom out and look at things from a long-term perspective, Visa's business model is still very rock solid, and just like with Rollins, that's going to show up in the financials. Visa's charts and Rollins are actually pretty identical. Everything is just straight up and to the right from top to bottom, once again at very aggressive rates. Revenue's grown by 11% on average over the last 10 years, earnings per share even faster at 16%, and once again, free cash flow is the fastest, growing at about 18.4% on average. And then scrolling down, looking at the debt, even though they do have about $9 billion of net debt on the balance sheet, if we look at the net debt to free cash flow, this is only 0.41 in the trailing 12 months. So they're bringing in more than twice as much free cash flow per year than they have net debt. So they could wipe all of that out in no time if they needed to. And on the topic of debt, one thing that a lot of people actually don't realize about Visa, and this is a really important component to their business, is that they have no credit risk. They are not on the hook whatsoever for any outstanding credit card debt that you might have when you don't pay your credit card bill. I said it earlier, but Visa is just a payment network. Your bank, who is probably the one that issued you your credit card, they're the ones who are on the hook for that credit card debt since they issued you that line of credit. Once again, that's a really important distinction to make for a company like Visa. But anyway, looking at the dividend stats, the thing about Visa's dividend here is that the yield is not high at all. In the trailing 12 months, you're getting a 0.64% dividend yield, so definitely nothing to write home about. But who knows, if we saw a pullback in share price, maybe we could see it eventually get above 1%. I think that would be really sweet. We would need quite the pullback for that to happen, but stranger things have happened. And nonetheless, even with its low starting yield, the 5 and 10-year dividend growth rates are both looking really good, 15% over the 5-year, and it's even higher over the last 10 years. And unsurprisingly, this dividend is very well covered. The earnings payout ratio is only about 22% in the trailing 12 months, so plenty of room to continue growing and paying the dividend while also reinvesting back into the business to continue the growth there. That's very important. And also the free cash flow payout ratio is just as low, actually slightly lower at only 21%. And then if we scroll down looking at the returns on invested capital, this is a great looking chart. This is actually just going up and up and up. And in the trailing 12 months, their return on invested capital has officially crossed the 30% mark. So as far as reinvesting capital goes, this company's just getting better at it over time. So guys, those are the two stocks that I will be loading up on if the market crashes. Rollins and Visa, two very high quality companies. But here's the thing, I'm not just sitting around waiting for a crash to happen. Over these last few weeks, I actually went on a pretty serious buying spree and in total invested over $8,000 into the 3 stocks that I'm telling you about in this next video right over here. In total, all that buying added hundreds of dollars to my projected annual dividend income. And if you want to see the 3 stocks that I just loaded up on, click right over here to check them out, and I'll see you in the next one.